Texas's housing market is breaking faster than the industry ever predicted. What's lining up for 2026 could hit harder than 2008. I've pulled the numbers big money didn't plan on you seeing, data that puts Texas real estate on a countdown clock. If you thought 2008 was bad, pay attention. The same forces that drove prices up, cheap coverage, aggressive building, and relentless in-migration, are now snapping the other way. Insurance premiums jumping, property taxes squeezing monthly payments, a construction wave flooding supply, and lenders tightening right when buyers need air. This isn't a cool down, it's a fast reset that can wipe out tens of billions in paper equity. Texas grew because the math worked. In 2026, the math flips. Builders chase absorption with concessions. Private sellers chase the builders. Approval letters thin out, and prices move. I've got the receipts. Now let's see why Texas home prices will crash in 2026 and who gets hit first. The insurance shock. The deal dies in the monthly, not the price. In Texas, insurance is the quiet line that tips that monthly over the edge. It creeps up three ways at once: higher premiums, fatter deductibles, tighter coverage. Nothing about the house changes, but the escrow does. A quote lands higher than last year. The lender reruns your ratios. The approval that felt safe now lives on the edge. That's how a yes turns into a maybe, and maybe kills offers. It hits hardest where risk stacks. Coastal ZIPS needs separate wind coverage. Hail belts face tougher roof rules and depreciation schedules. Newer subdivisions get updated replacement cost assumptions mid-transaction. Every path points the same way, up. Buyers step back, appraisers get conservative, and underwriters shave amounts. Prices are set at the margin. Remove marginal buyers, and you remove the highest prints. Closings don't fail at open houses, they fail in inboxes. The binder stalls, the carrier wants new docs. The premium is higher than the pre-approval modeled. Days slip, confidence fades, the buyer asks for a credit, or walks. One failed binding is unlucky. 10 on one block is price discovery. How to beat it before it beats you. Win the payment, win the buyer. If you're selling, treat insurance like part of the product. Shop carriers early. Bring a bindable quote into the listing. Fix borderline roof items so the binder isn't a fight. Compete with builders on payment, not nostalgia. Targeted credits that trim year one costs beat stubborn list prices. If you're buying, get 3 quotes before you fall in love. Ask roof age, claim history, wind/hail rules, and what that deductible means in real cash. Run the renewal math, not just the closing math. If you're investing, underwrite ugly. Higher premiums, bigger deductibles, flat rents. If the deal still pencils, it's real. If it dies on paper, it would have died in your bank account. Insurance is the first domino because it raises the monthly without touching the sticker. Once the monthly gets heavy, everything else gets heavier with it. And that leads straight to the next pressure Texans hate to pay and can't ignore: property taxes. Property taxes versus cash flow. Taxes don't hit once, they hit every month. Buyers chase a payment, not a sticker, and property taxes live inside that payment forever. Even when headlines promise relief, the escrow tells the truth. Assessments reset, local rates nudge, insurance creeps, and the lender quietly recalculates. The roomy pre-approval turns tight. The house that looked easy suddenly needs a concession. A tiny tax swing changes who can bid. 2 near identical homes in 2 districts become 2 different buyer pools. Builders attack the monthly directly with rate buydowns and prepaid items. Private sellers can't match that toolkit at scale, so they end up chasing the builder's cleared payment with price cuts. And because reassessments roll through the calendar, the squeeze arrives in waves. Fewer approval letters here, softer appraisals there, while the market still looks stable on paper. Beat the tax before it beats your deal. Win the payment and you win the buyer. If you're an owner, claim homestead, calendar your protest window, and package certainty. Last year's bill, this year's notice, and a realistic escrow projection. Price against builder payments, not last spring's comp. A targeted credit that trims year one escrow lands harder than a cosmetic list price tweak. If you're a buyer, interrogate the payment, effective tax rate, reassessment cadence, and the lender's escrow after the first true up, and run the budget at renewal, not just at closing. Investors should underwrite a fatter tax line and flat rents. If the deal survives a small mill rate bump without blowing DSCR, it's real. Taxes keep the monthly heavy, and that weight meets the next pressure. a supply wave that keeps rolling even after the cranes leave. The supply wave, 2025 to 2026 echo. Supply doesn't ask permission, it shows up with keys. Texas pushed a massive pipeline through in 2025, and the ripple runs straight into 2026. First, rents feel it. Free months appear. Parking gets thrown in. Lease-ups stretch longer than pro formas promised. Effective rent slides even when the sticker doesn't. Investors read the P&L, not the brochure. Operating costs creep up while top line stalls, and the hold forever story starts to wobble. Some list early to get ahead of the curve. Others try to outlast concessions and watch vacancy nibble away returns. Either way, the market absorbs the same message. There are more doors than committed tenants, and time favors the side with inventory. How soft rents become soft comps. Concessions in rentals turn into concessions in sales. When landlords dangle a free month, they reset expectations for everyone. On-the-fence buyers see cheaper, easier renting and pause. Builders move next. They buy rates down, stack closing help, and clear inventory. Because clearing inventory is their business model. Private sellers can't run that play at scale, so they end up chasing the builder's payment, not the builder's price. Appraisals follow the transactions that actually close, not the listings that wish they did. That's how rent softness bleeds into resale softness, quietly at first, then all at once in the comps. Supply doesn't crash a market by itself, but it tilts the playing field, especially when buyers already hurt on monthly cost. And that sets up the next move, the fragile plateau, where charts still look calm while leverage quietly shifts to the buyer. The fragile plateau. Flat lines fool people. A market can look steady on a headline graph while leverage quietly slides to the buyer. Inventory inches up, days on market stretch, and price cuts hide behind seller credits and rate buydowns. Listings still launch high, but the real action happens in the second and third weekend, when silence in the inbox turns into a discount in the contract. That's a plateau in name only. Beneath it, the monthly is heavy, the buyer pool is thinner, and appraisals start reflecting the deals that actually closed, not the ones that tried to. From holdout to sell now. Stubborn listings don't age, they harden. The longer a home sits, the more buyers wonder what's wrong, and the sharper their offer gets. Sellers test yesterday's number, buyers negotiate today's payment. When the gap won't close, the first real move is concessions, then a cosmetic price trim, and finally a reset to where traffic returns. Multiply that across a neighborhood, and you get a slow-motion repricing that a flat median can't show. This is where patience stops working and strategy starts, especially with builders next door buying rates down and clearing units, which is exactly where we're headed next. Builders versus private sellers, payment war. Builders don't sell houses, they sell payments. National builders come loaded with levers, temporary rate buydowns, 2-to-1, 3-to-2-to-1, lender credits, prepaid HOA, closing cost help, even free upgrades that offset cash at closing. They move spec inventory like a factory. Clear units, hit quarter, repeat. When they buy your rate down 2 points for year one, the monthly looks thousands cheaper than a same price resale. And buyers shop the monthly, not the marble. Appraisers see where deals actually close, not where listings hope to land, so the comps start forming around the builder's cleared payment. That's why a neighborhood can feel stable while values quietly drift toward whatever number the builder's incentives imply. How resales catch down. Private sellers don't compete with the list, they compete with the lender sheet. If a builder can deliver the same monthly with a higher sticker, thanks to buydowns, the resale must either match the payment or watch traffic fade. That's why you see the same pattern. First a small concession, then a cosmetic cut, then a full reset to the number that generates showings again. Savvy sellers flip the script. Pre-shop insurance, pair the listing with a real, bindable quote, and offer a targeted credit that the buyer's lender can use to trim the monthly points. Escrow, PMI. When you attack the payment directly, you stop bleeding time and start creating comps that work for you. This is the payment war, and builders set the pace, which is exactly why the next chapter matters. When credit tightens, fewer buyers can even use those incentives, and the market shifts again. Credit tightening. Prices don't fall because people panic, they fall because approvals disappear. Lenders take their cues from risk. When losses creep up or certain zip codes look shaky, guidelines inch tighter. Higher minimum scores, lower DTI caps, stricter reserves, more verification. Marginal approvals turn into come back with more cash. Strong borrowers still close, but the edge of the market, those last few bids that set the high print, goes quiet. That's subtraction pricing. Remove the top buyers and you remove the top prices. How tighter credit resets prices. Credit is oxygen. Less oxygen means lower ceilings. With fewer qualified buyers, listings sit longer and sellers start negotiating the monthly. Points, buy downs, prepaid escrows. Appraisals then mirror the net results of those deals, not the wishful list price. That's how an area can look stable at first, while the effective prices slide underneath via concessions. Investors feel the pinch too. DSCR loans tighten, rate sheets widen, and the refi exit gets farther away. Some will delever or sell. Both actions feed softer comps. When credit gets picky, every other pressure lands harder. Insurance, taxes, supply, and that's why the next piece matters. Migration math. Texas is still growing, but is growth enough when the numbers flip? Migration math. Texas is still growing, but growth doesn't pay your escrow. New arrivals keep the long-run story strong, yet 2026 is about the monthly right now. If insurance stays firm, taxes stay heavy, and credit gets picky, raw headcount can't clear prices by itself. The composition matters. Fewer cash-rich, equity-heavy buyers and more payment-sensitive movers tilt demand toward lower price points. That's how hot metros stay busy on tours while high-end listings stall. Inflows help absorption, but they don't erase concessions, they don't rewrite appraisals, and they don't make approval letters appear for borrowers the lender just trimmed out. When inflows hit friction, more people plus more doors does not equal higher prices if the doors outnumber approvals. Builders target the middle with buydowns. Private sellers at higher price tiers end up chasing those effective payments. Meanwhile, some out-of-state buyers rethink moves once they see real insurance quotes and true tax bills. Intent turns into indecision, and indecision turns into longer days on market. Remote work pullbacks add another king. The move-anywhere crowd is smaller and choosier, and a portion of last cycle's peak buyers quietly pivot to rent, especially with shiny lease-up specials and brand-new communities. The result is demand that spreads out, not demand that bids up. Migration keeps Texas busy. The monthly decides who wins. Next, weather and claims risk, why storms and claim patterns quietly shape coverage, availability, and the deals that survive. Weather and claims risk. The weather writes the policy you end up paying. After big hail or flood seasons, carriers don't just raise price, they change terms. Roofs age faster on paper. Deductibles shift to percentages. Exclusions creep in where they didn't exist last year. The effect is invisible until the binder lands, and then the whole deal pivots around one line you didn't model. Buyers who thought they could stretch can't. Sellers who thought they had a clean path to closing start hunting for credits to keep the contract alive. Appraisers see the concessions, underwriters see the claims data, and the next three approvals in that ZIP code get a little tighter. That's how a local storm becomes a pricing story 3 months later. Availability is a price. When coverage gets hard, value gets soft. Some areas don't lose insurance entirely, they lose choice. Fewer carriers quoting, stricter inspections, slower turn times. Fewer quotes means higher quotes, and higher quotes mean fewer qualified buyers for the same house. Investors feel it in NOI, owners feel it in escrow, buyers feel it in DTI. The smartest listings now arrive with proof, roof reports, recent claim histories, and a bindable quote attached to the MLS sheet. That package isn't marketing, it's leverage. It shrinks the unknowns and wins the tiebreaker when 3 similar houses fight for one cautious buyer. Weather risk doesn't have to be catastrophic to change outcomes. It just has to be consistent. And when it is, the monthly won't blink, which brings us to the pressure point where the math shows up first on a P&L. The investor squeeze. Cash flow doesn't care what you paid. Insurance climbs, taxes creep, maintenance wakes up, and the rent roll won't cooperate because concessions are everywhere. Your net operating income shrinks while market cap rates drift up. So the value you thought you had gets repriced lower, even if your street looks stable. Push rents and vacancy pushes back. Hold rents and yield compresses. Either way, the spreadsheet stops being a friend. The refi you planned for 2026, tougher DSCR, wider spreads, stricter reserves. The exit you penciled at last year's multiples. Today's buyer underwrites with uglier lines and asks for a discount to match. Leverage turns from booster to brick. Adjustable debt resets higher, IO periods roll off, and the bridge to somewhere trade meets a slower lending desk. Some owners try to buy time, cut capex, stretch vendors, squeeze payroll. Time is expensive. Tenants can smell a stressed operator. Service slips, online reviews follow, vacancy widens the hole. That's when hold and hope becomes list and leave. Not because the asset is bad, but because the math is done arguing. How smart operators survive the turn. Fix the monthly before you fix the marketing. Requote insurance with higher deductibles paired to a funded reserve. A painful deductible works if the reserve is real. Hunt utility savings that actually move NOI. Attic insulation, LED retrofits. Water fixtures, measurable in the next billing cycle. Reprice units by velocity, not ego. Keep best-in-class product at market and use surgical concessions on the slow stack. Trim non-essential amenities that don't lift rent or retention. On debt, extend and amend beats extend and pretend. Trade points for time only if the business plan survives a harsher cap rate exit. Investor pressure doesn't stay on the P&L, it spills into the neighborhood through price cuts, quick dispositions, and lower benchmarks. That's what sets up the next move. Appraisals and comps reset, how the deals that actually close quietly drag the whole market down to their number. Appraisals and comps reset. The only price that matters is the one that closed. Listings can dream, but appraisals live on recorded deals, net of concessions, rate buydowns, and seller credits. When builders clear inventory with incentives, those net numbers start anchoring the neighborhood. Appraisers don't chase the sticker, they back into the effective price. That's why a street can feel stable, while values drift lower underneath. Each closed contract with points and credits bakes a quieter comp that trims the next appraisal. Sellers sense it when the second buyer's lender flags the same three comps. Buyers feel it when their approval shrinks after the appraisal shave. This is how a plateau turns into gravity. Comps march to where deals actually cross the finish line. How to bend comps in your favor? If you can't beat the comp, change the comparison. Sellers, package your value. Lead with recent verifiable upgrades that appraisers can adjust for: roof, HVAC, windows insulation. Not vanity items they can't. Attach a bindable insurance quote and clean inspection to reduce lender risk. Fewer conditions equals smoother underwriting. Price against the effective builder payment, not the neighbor's 2022 number, and offer a targeted credit, points, escrow, that appraisers can net cleanly. Buyers, build your offer around the appraiser's world. Cite the freshest comps and line item the incentives to justify your number. If the appraisal still comes in light, use it. Renegotiate price instead of throwing more cash at a shrinking equity cushion. Investors, sell into clarity. Buy as if the comp stack will look worse in 90 days. Comps don't just mirror the market, they steer it. And once the numbers steer lower, the tricks that help buyers can start hurting deals, unless you use them right. Financing tricks and pitfalls. Buydowns can win the payment, but they can also boomerang. Temporary buydowns, 2-1, 3-2-1, make year one look cheap, which is why builders love them. But when the step-up hits, that payment jumps, right when insurance renews and escrow resets. If your budget only works at the teaser, it doesn't work. Permanent buydowns points are cleaner, but only if the math pencils. Divide the cost of points by the monthly interest savings to get a break even in months. If you won't keep the loan past that line, don't buy the points. Use seller credits where they hit the debt to income the hardest, points and escrow, not granite and paint. How to use leverage without getting used by it. Structure the loan to survive the year you're worried about. If you need help, aim credits at permanent costs first, points, MI, escrow. Ask your lender for a side-by-side. No points versus 1 point versus 2 points, with true cash to close and break even in months. Lock with a float down only if it's automatic and written. We'll see is not a clause. Clean files win tight markets. Pay down a small card to drop DTI, season reserves. Avoid big purchases before closing. If you must take a temporary buy down, build a sinking fund equal to the step up so month 13 doesn't blindside you. Sellers, offer credits that change approvals, not decor. Investors, underwrite with the real rate, stress at plus 100 to 150 basis points, and make sure DCR lives there. Financing hacks can bridge a gap, but in 2026, the bridge needs to land on solid ground. which is why the next part matters most. The 2026 convergence timeline, when each pressure point hits quarter by quarter. The 2026 convergence timeline, Q1 2026. Insurance renewals from late 2025 roll through mailboxes, and year one builder buy-downs from 2025 deals start stepping up. Lease-ups from the 2025 pipeline still toss concessions, pulling renters off the fence. Tax notices and escrow recalcs land, shaving buying power as spring listings prep. Appraisals start reflecting net of incentive closes from late 2025, not wishful list prices. Sellers feel the silence first. The response is credits, then cuts. Q2 2026. Spring inventory hits stride. More comps close with points and buy-downs, anchoring valuations lower than stickers imply. Hail season adds fresh claims in key belts. Carriers tweak deductibles and terms, and a few ZIPS see slower, pricier quotes. Some 5/1 adjustables from 2021 begin resetting, nudging a slice of owners toward listing. Builders defend velocity with deeper buy-downs. Private sellers chase the payment, not the sign price. Q3 2026. Peak hurricane window on the coast meets the back-to-school demand dip. Tax protests settle, new bills get priced into lender escrows, and approvals tighten another notch for payment-sensitive buyers. Investors read YTDNOI, insurance, taxes, and concessions don't lie, and a wave of sell before year-end decisions hits. Builder inventory clearouts return after summer slows, pulling comps toward their effective prices. Q4 2026. Year-end is when the math stops negotiating. Builders run quarter-close blowouts. Investors do tax-motivated exits. Lenders clean risk. ARMs that reset late in the year tip more owners into refi or sell, and refi boxes are smaller. The comp stack going into 2027 is reset by a full year of net price closings. Headlines finally catch up. Local price action is already there. What flips when the lines cross? Affordability sets the floor, credit sets the ceiling, and supply presses both. Insurance keeps the monthly heavy even if rates wiggle. Taxes lock that heaviness into escrow. Credit decides how many buyers can still clear the bar, and supply dictates how quickly sellers must bend to meet them. By mid-2026, those lines cross long enough to move prices, not everywhere at once, but fast where risk resets in inventory cluster. The winners aren't guessing, they're reading that calendar and acting early. Who breaks, who holds, how you win, who gets hit first. Thin equity owners, short-term and build-to-rent in oversupplied pockets, adjustable bridge debt resetting in 2026, and high-tax/insurance-sensitive ZIPS, where quotes are scarce and deductibles bite. Luxury jumbo stalls sooner because the borrower pool is smaller and pickier. Year one buy-down buyers without a plan for month 13 show up as new listings, resetting comps. Who survives? Median price homes with low operating costs, owners locked into low fixed rates who don't need to sell, and submarkets tied to durable job nodes, logistics, healthcare, energy, advanced manufacturing. Clean HOAs with transparent budgets beat flashy amenities with heavy dues. Who wins? Cash buyers in Q3 to Q4 2026 set the floor. Owner occupants who aim credits at permanent cost win approvals. Savvy sellers price against the effective builder payment and attach bindable insurance. Operators who lift NOI beat cap rate drift. The pattern is simple, the monthly rules. Your 2026 playbook. Owners sell the number, not nostalgia. Pre-shop insurance and attach a bindable quote. Fix roof/system items that trigger underwriting. Price to beat the builder's payment next door. If you can hold on a low fixed rate, spend 2026 improving the asset and document it. Buyers structure to survive year two. 3 insurance quotes before you commit. Run the renewal math, not just closing math. Compare permanent points by break-even months. If you take a temporary buy-down, fund a sinking reserve for the step-up. Shop resales against the builder's effective payment and make your offer to beat that number. Investors, underwrite ugly, operate sharp. Model higher insurance, heavier taxes, flat rents, and a wider exit cap. If it still pencils, it's real. Cut costs that hit the next bill. Attic insulation, LEDs, water fixtures. Fund a real deductible reserve. Price slow stacks by velocity, not ego. If refinancing won't clear DSCR, negotiate time only if the plan survives a harsher exit. If selling, sell into clarity, clean T3/T6 current, binder, recent roof/HVAC docs. Final word, 2026 is the hinge. Insurance keeps the monthly heavy, taxes lock it in, credit thins approvals, and supply presses the rest. That's not doom, it's a map. Act before the averages catch up. Price to the payment, package certainty, and pick structure over slogans. Do that, and you won't just get through the reset, you'll be the one setting the new comps when the dust settles in 2027. If you want the real-time signals and city-by-city breakdowns as they hit, subscribe now and turn on notifications so you move before the averages do.